Bitcoin has suffered a prolonged 6-month decline, shedding over 25% of its value since the start of 2026. Starting near $87,500, it ground down in a staircase pattern towards $60,000. Trading volume alongside this drop lacks massive liquidation spikes, remaining consistently low. This jagged shape flushes leverage gradually, safely releasing pressure without a margin call cascade. We are watching a slow, calculated extraction of liquidity that requires a precise analytical framework to understand. The current market environment operates under entirely different mechanics than the 2022 crypto collapse. That previous collapse ran on unchecked contagion. The failure of one entity, like Terra or FTX, directly forced the liquidation of the next. The 2026 drawdown is a mechanical repricing. It is driven by highly regulated algorithmic sell pressure. To predict the true floor of a mechanical market, we have to build a 3-tiered analytical model: macro, structural mechanics, and microstructure. To determine if Bitcoin holds $60,000 or slides to the $50,000 analyst targets, we must dissect the forces actively pulling capital from these 3 layers. We begin at the foundation: macroeconomics. This layer acts as the gravitational pull on all asset prices. While the decline began in January, the shock that currently threatens to drive prices to new lows arrived on June 17. This was the moment the Federal Reserve delivered an unexpected, hawkish policy pivot. This chart is a recreation of the Fed's dot plot. Officials shifted their forecasts, moving the median cluster of dots upward to project a rate of 3.8%, officially pricing in a possible hike by December. That reversal had an immediate downstream consequence on fixed income markets. The yield on the 2-year Treasury note spiked violently upward. Zooming out on this chart over a 20-year timeline, we see the severity of that move. It was a 16 basis point jump, the most extreme single-day move on a Fed decision since March 2008. The core law of asset pricing dictates that when risk-free government bonds suddenly yield higher returns, non-yielding assets like Bitcoin are structurally forced to reprice downward. Moving up to the middle tier of our model, we examine the structural mechanics actively bleeding capital out of the ecosystem. The first major seller driving this decline is exchange-traded funds, processing daily, regulated redemptions. This data visualization shows a recent 30-day timeline for U.S. spot Bitcoin ETFs. Heavy outflows accumulated into a massive $6.35 billion deficit. The second source of structural selling originates from large-scale, publicly traded Bitcoin mining operations. Rising geopolitical energy costs have severely squeezed miner profit margins, forcing them to liquidate their own Bitcoin reserves simply to survive. Public filings reveal Mara liquidated $1.1 billion worth of Bitcoin to slash corporate debt, alongside a $289 million sell-off by Riot Platforms. These ETFs and mining firms are algorithmically dumping supply onto the market, regardless of current sentiment. The third and final structural pipeline involves corporate treasury companies. This dual-line chart tracks MNAV compression. This is the premium at which a corporate treasury stock trades relative to the actual Bitcoin it holds. Early price weakness in spot Bitcoin caused this premium to collapse. Metaplanet, for example, saw its stock drop from trading at an 8x premium down to roughly 2x. A high MNAV premium provides these companies with the fundamental financing edge required to issue debt and purchase more Bitcoin. The compression of this premium effectively shuts off the corporate buying engine, drying up institutional demand precisely when miner and ETF supply hits the market. This brings us to the final, top tier of the model, the microscopic physics of the order book. The data presents an apparent paradox. Net capital is leaving the ecosystem, yet the price floor near $60,000 is physically thickening with buy orders. The short-term holder MVRV ratio has climbed back to 0.90. Steady capital has stepped in at lower prices, successfully absorbing the losses of exiting leveraged traders. But an invisible ceiling counteracts this support, formed by a massive band of negative gamma hanging directly above the current price. Looking directly at the vertical price ladder, we can map this dense structural barrier sitting squarely between $66,000 and $71,000. Under a negative gamma regime, options dealers are mathematically forced to sell into any upward rally to hedge their books, actively suppressing upside breakouts. The price action is currently trapped by pure order book physics, a stabilizing floor at $60,000, grinding against an algorithmic, self-reinforcing ceiling at $71,000. Applying this assembled model evaluates where the market goes next. Two projections dominate: Standard Chartered's $50,000 base case and Galaxy's $40,000 tail case. Current variables, a hawkish Fed, minor liquidations, and heavy gamma resistance, map directly to Standard Chartered's model, mathematically supporting a slide to $50,000. Reaching Galaxy's $40,000 projection requires evidence of extreme MNAV capitulation across Treasury companies, a variable that does not yet exist in the data. Based strictly on the systemic gravity inside these three layers, a mechanical descent to $50,000 is the most probabilistically sound outcome. This downward trajectory is highly structured, which means breaking the grind requires very specific shifts to occur in the system. The first invalidation trigger is a dovish surprise at the upcoming July FOMC meeting. A pivot from the Fed relieves the macro pressure instantly. Second, ETF flows must turn consistently positive for weeks, not just days, to structurally counter the ongoing minor liquidation. Finally, spot buyers must achieve a clean, high-volume break entirely through the $71,000 gamma band, rather than stalling out at its edge. Until the Fed pivots or structural demand returns to overwhelm the mechanical sellers, the market's path of least resistance will remain a slow, calculated descent.